Welcome to Cost Saver Conversations. I'm Angela, and I ask the practical questions so you can quickly understand what matters. Today, I'm joined by Assad.
Hi, Angela. We're unpacking sole trader versus limited company in the UK, hidden costs and tax pitfalls to avoid in 2025-26 today, and tying it back to the wider cost saver ecosystem, including tools like sole trader versus limited company calculator, freelancer day rate calculator, and self-assessment payment schedule calculator, so you can turn insights into action quickly.
Just a heads up before we dive in, we are your synthetic hosts. We are great with numbers, but as AI, we can sometimes be confidently wrong. Think of us as the digital versions of your most knowledgeable, slightly caffeinated friends.
Exactly. Treat this chat as a smart estimate only, not as professional financial guidance. Always check important details with official sources or a qualified expert before making any big decisions.
Welcome back, everyone. Today, we are getting into something that, honestly, I think this trips up more people than almost any other business decision. We're talking sole trader versus limited company, specifically for the 2025-26 tax year. Assad, welcome back.
Thanks, Angela. Good to be here. Yeah, this is one of those topics where everyone thinks they know the answer because their mate told them what to do, and then they find out 2 years later they've been doing it wrong.
The classic my mate Dave says approach to tax planning.
Exactly. And look, that might have worked, 5 or 6 years ago when things were simpler. But 2025-26, the landscape has properly shifted. Higher dividend costs, corporation tax is more complicated now, and HMRC they're watching more closely. That's the reality.
Tighter scrutiny. Love that for us. So, what's actually at stake here? Like, if someone gets this wrong, are we talking a few hundred quid or?
No, no, we're talking you could easily overpay by $2,000 to $5,000 a year, and not just for 1 year, for years on end if you don't catch it. Or you create this massive admin burden that just eats the saving alive, and then, worst case, HMRC penalties on top of that.
$5,000 a year. That's a lot.
It really is. And the thing people don't always get is there's no universal winner here. The right answer depends on your profit level, how much you actually spend, whether you can stomach the paperwork, what your plans look like for the next few years. It's genuinely personal.
Hmm, that's actually kind of reassuring in a weird way. Like, it's not that you're stupid if you haven't figured it out, it's that it's genuinely complicated.
Exactly. And I should say this early, your business structure is not a lifetime sentence. You can start as a sole trader and incorporate later. Or you can close a limited company and go back to self-employment if it stops making sense. People forget that.
Oh, that's actually reassuring. Okay, so let's get into the numbers because I know people are going to want the specifics. What are we looking at for 2025-26?
Right. So, sole traders first. Your profits go through self-assessment. Personal allowance, 0 to 12,570, that's at 0%. Then basic rate, 12,571 to 50,270, that's 20%. Higher rate kicks in at 50,271 up to 125,140 at 40%. And then above 125,140, it's 45%.
Okay.
And then on top of that, you've got Class 4 national insurance, 6% between 12,570 and 50,270, and 2% above that. Class 2 NI has effectively been abolished for most people, although there's a voluntary contributions angle for state pension that some people should still think about.
Right, right. So that's the sole trader side. And for a limited company, it's a whole different thing, isn't it?
Yeah, completely different mechanics. Corporation tax is 19% on profits up to $50,000. That's the small profits rate. Then there's this marginal relief band between 50,000 and 250,000, where the effective rate sort of creeps up from 19% towards 25%. And then above 250,000, it's the full 25%.
So even the corporation tax bit isn't straightforward anymore.
No, and then here's the bit people forget. Once you've paid corporation tax, you still need to pay yourself, which means dividend tax. After a $500 dividend allowance, you're looking at 8.75%, 33.75%, or 39.35% depending on your personal band.
So it's tax on top of tax, essentially.
Kinda, yeah. And this is important. The employer national insurance threshold reduction and rate increase from April 2025 means that old strategy of pay yourself a tiny salary, take the rest as dividends, it's not as cheap as it used to be. You really have to factor that in now.
Wait, really? That was like the everyone's go-to move, wasn't it? Low salary, high dividends?
It was, and it still has merit, but the margin is thinner. Does that make sense? The maths has genuinely changed since the 2023 corporation tax rise and the dividend allowance cut since 2022.
Yeah, no, that makes sense. So, okay, I remember hearing years ago that the crossover point where a limited company starts saving you tax was around $25,000 profit. Is that still?
No, it's drifted upwards. For 2025-26, most accounts now put the genuine crossover somewhere between $30,000 and $40,000 of annual profit. And even then, only if you're extracting profits efficiently and keeping admin costs tight.
$30,000 to $40,000. That's a big jump from $25,000.
It is. And below that level, the saving is usually just too small to justify the extra paperwork and fees. Above it, though, the gap widens, especially if you can leave some money in the company rather than drawing everything out.
Okay, so what shifts that crossover point around? Like, what makes it $30,000 for one person and $40,000 for another?
Loads of things, actually. How much profit you need to live on each year is a big one. Whether your spouse or partner can be a shareholder. How much you can leave as retained earnings. Your pension contribution strategy. And this catches families off guard, whether you claim child benefit, because the high-income child benefit charge kicks in from $60,000 adjusted net income.
Right. There's a lot of moving parts there. Do you have like a real example of someone who's been through this?
Yeah, so Sarah, a freelance designer from Bristol, she hit this decision at $45,000 profit. As a sole trader, she was paying around $10,400 in income tax and Class 4 NI. She incorporated, split shares with her husband, got the combined tax bill down to roughly $7,800. So on paper, $2,600 saving.
That's decent.
It sounds great, right? But then she took on $1,500 in accountancy fees. So her actual net gain was closer to $1,100. Still worthwhile, but it's not the $3,000 saving the original quote implied.
I hadn't thought about it like that. So the headline number and the actual number can be really different.
Massively different. And that leads into something I really want to talk about, which is the hidden cost that nobody mentions. The glossy articles kind of stop at the text comparison and go, ta-da, you'll save money. But they don't tell you what it actually costs to run a limited company.
Go on.
So, accountancy fees. A sole trader can usually file their own self-assessment or pay an accountant $200 to $400 a year. A limited company, you're looking at $600 to $1,500 just for annual accounts preparation. Then there's the confirmation statement, 34 pounds to company's house plus your accountant's time. Payroll processing for your director's salary, that's $10 to $30 a month. Bookkeeping software, $15 to $40 a month for something that's MTD compliant. And if you're VAT registered, that's more on top.
So you're saying all in, a limited company could cost you...
Easily $1,200 to $2,500 a year before your tax saving even starts to count. And I'd say get quotes from at least 3 accountants. Ask specifically what's included. Some do all-in monthly fees, others charge extra for every phone call. A 15-minute comparison call can genuinely save you 500 pounds a year.
Fair enough. That's good practical advice. Now, what about making tax digital? Because that's coming for sole traders too, right?
Yeah, so MTD for income tax self-assessment is phasing in from April 2026 for sole traders and landlords with income above 50,000 pounds. Then it drops to 30,000 in 2027 and 20,000 in 2028. So the admin gap between the two structures is actually narrowing, but limited companies still have that extra layer, statutory accounts, corporation tax returns on top of everything else.
Interesting. So sole traders are losing some of that simplicity anyway. What about bank accounts and insurance? Is there much difference?
Sole traders can technically use a personal account, though most banks now want you on a business one. A limited company legally must have a separate business account because it's a separate legal entity. Fees are typically $5 to $15 a month once any free period ends. Insurance is broadly similar between the two, but directors of a limited company often need directors and officers cover on top, which is another cost.
Okay, so we've talked about the costs. Now I want to get into the scary stuff, the actual tax pitfalls. What trips people up?
Where do I start? Director's loan accounts is a big one. So if you take money out of your company that isn't salary, isn't a dividend, isn't an expense reimbursement, it sits in your director's loan account. If that account is overdrawn by more than £10,000 at any point in the year, it's treated as a benefit in kind and you pay tax on the deemed interest.
Wait, so you're paying tax on money you've essentially borrowed from your own company?
Yes, and it gets worse. If the loan isn't repaid within 9 months and 1 day of the company's year end, the company pays a 33.75% Section 455 tax charge on the outstanding balance. You do get it back eventually once the loan's repaid, but HMRC just sits on your money in the meantime.
That's wild. 9 months in 1 day. That's oddly specific.
Tax law loves oddly specific deadlines. But the other one that really gets people, dividends declared without enough profit. You can only pay dividends out of distributable reserves. That's accumulated post-tax profit. If you pay yourself dividends when the company hasn't actually made enough profit, those payments are technically illegal.
Illegal? That's a strong word.
It is, and HMRC may reclassify them as salary, which triggers backdated PAYE and national insurance. I mean, a reclassification on $40,000 of dividends can land you a PAE bill of over $12,000 plus interest and penalties.
Oh my God, 12,000. That would wipe out years of tax savings.
Completely. And the thing is, the fix is so simple. Check your management accounts show enough retained profit. Hold a board meeting, even if it's just you sitting at your kitchen table, minute the decision. Issue a dividend voucher. Do it at the time, not retrospectively. People say, I'll sort the paperwork at year end, and that's exactly how they end up in trouble.
Does that make sense to people, though? Like, holding a board meeting with yourself feels a bit performative?
It does, I know. But it's what protects you. It takes 5 minutes, and trust me, it's better than a $12,000 bill.
Fair enough. Now, what about IR35? Because that's the one I hear contractors worrying about constantly.
Yeah, so if you run a limited company and work for medium or large clients through it, the client is responsible for deciding whether you're inside IR35. If they decide you are, they deduct tax and NI at source as if you were an employee, but you still carry all the admin overhead of running the company. It's genuinely pushed some contractors back to sole trader status or umbrella arrangement.
So you're paying company running costs but getting taxed like an employee anyway? That's the worst of both worlds.
Exactly. If most of your income comes from one long-term client who controls how you work, get proper IR35 advice before incorporating. Seriously.
Okay, and you mentioned the child benefit charge earlier. Can you come back to that?
Yeah, so the high-income child benefit charge. If your adjusted net income goes over $60,000, you start losing child benefit. It's fully tapered away by $80,000 in 2025-26. As a sole trader, your profits feed directly into that. As a director, you have some control over timing of dividends to manage when income gets recognized, which can be a genuine planning advantage for families.
But only if you plan ahead, I'm guessing.
Right. Taking a big dividend in March without thinking about it can trip the threshold when an April payment would have been fine. It's one of those things, you know?
So, with all these complications on the limited company side, I want to make sure we're being fair to sole traders here, because it sounds like for a lot of people, staying simple is actually the smart move.
100%. Sole trader status is not second best. For a huge number of UK businesses, it's genuinely the right structure. Simplicity, speed, flexibility. One tax return a year by January 31st. No company's house filings. Full control of every penny. Much simpler records. And if the business doesn't work out, it's way easier to wind
wind up. You can even offset business losses against other income in some cases.
What about the liability thing, though? That's the one that scares people into incorporating.
Yeah, unlimited personal liability is the main downside. If your business gets sued or can't pay its debts, your personal assets are on the line. But for low-risk trades like writing, consulting, tutoring, decent professional indemnity and public liability insurance often gives you enough protection. We're talking $150 to $400 a year for typical cover, compared to $1,500 plus in running costs for a small limited company.
So the insurance route is genuinely cheaper than incorporating just for the liability protection?
For most low-risk businesses, yeah, significantly cheaper.
Okay, I want to quickly tackle some common worries I know listeners will have. First one, won't incorporating hurt my credit?
No, forming a limited company does not affect your personal credit file. The company has its own credit profile that you build up over time, totally separate.
What if I change my mind?
You can close a dormant or trading limited company through a DS-01 strike-off for £33, or a member's voluntary liquidation if there are significant assets. Going back to sole trader takes weeks, not months.
And do I need an accountant from day one?
For a limited company, practically yes. For a sole trader, you can manage alone until profits pass around £30,000 or your situation gets complex. Multiple income streams, VAT registration, property income, that's when you want help.
And setting up a limited company, how long does that actually take?
Roughly 24 hours through Company's House for $50. Opening a business bank account adds another 3 to 10 working days. So it's not a huge barrier. It's more about whether it makes sense once it's set up.
All right, Assad, let's bring this home. If someone's listening right now trying to figure out what to do, what's the bottom line?
So for profits under about $30,000, sole trader status usually wins once you account for accountancy fees and your time. Between $30,000 and $60,000, it depends heavily on how you extract profit, whether you can involve a spouse as a shareholder, your pension strategy. It's genuinely a gray area. Above $60,000, a limited company starts to show clear advantages, particularly if you can retain profits or make meaningful pension contributions.
And the timing matters too, right? With MTD coming in?
Yeah, MTD for income tax starts for higher-earning sole traders in April 2026, so this is genuinely the right moment to review your structure. Don't wait for deadline panic. Run your own numbers with realistic figures. And if you're on the borderline, honestly, spend an hour with an accountant. It's the cheapest insurance you'll ever buy.
Love that. Okay, quick recap for everyone. Under 30,000 profit, sole trader usually wins. 30,000 to 60,000, it's personal, depends on your circumstances, how you draw income, whether a spouse can be involved. Over 60,000, limited company generally has the edge. Watch out for hidden costs eating your savings, keep your director's loan account clean, do your dividend paperwork properly, and don't leave the MTD review until the last minute. Assad, thank you. This has been incredibly helpful.
Thanks, Angela. Always a pleasure.
Quick side note, this guide connects with other cost-saver blogs, especially UK Tax Optimizer versus traditional tax calculators, 10 free ways to cut energy bills this winter, and complete guide to home insulation ROI.
Exactly. And reading those together helps you connect the dots across your household budget, not just this one topic in isolation.
And if you want to apply this immediately, jump into tools like Sole Trader versus Limited Company Calculator, Freelancer Day Rate Calculator, and Self-Assessment Payment Schedule Calculator right after this episode.
Primary sources used here include HMRC, Self-Employed National Insurance Rates and Thresholds, and gov.uk, Making Tax Digital for Income Tax, so you can verify the data yourself and stay evidence-led.
That wraps this cost-saver conversation with Angela and Assad. If this helped, share it with someone who could put these ideas to work this week.
Your next step is simple. Try Sole Trader versus Limited Company Calculator, then read UK Tax Optimizer versus traditional tax calculators, and use them together to take action today.